Hello, everyone, and welcome to Real Estate Up. I'm here with my incredible lawyer. Hello, Raluca. How are you?
Hi, Chaunyce. Thank you for having me.
Of course. Can you tell us what do you do?
So my name is Raluca Soika, and I'm the principal of RMS Estates Law, and I practice wills and estates and real estate law in the Greater Toronto area.
Thank you so much for your expertise and being here today. Today, we have a really important question. What's probate tax or administration estate tax? What is that?
So probate tax or estate administration tax is a tax that gets applied to all of the assets that a person owned at their date of death, with some exceptions. And those exceptions are any assets that are held jointly with someone else. That has exceptions as well, but for the most part, and any assets that have a beneficiary designated. So that would be life insurance that has a designated beneficiary, RSP, TFSA, registered accounts, pensions, things like that. So all of the assets other than those assets, um, minus any mortgages on title to any properties, they get netted. And on that net value, there's an estate administration tax that is calculated and needs to be remitted at the time the executor applies for probate, or otherwise known as certificate of appointment.
Okay, quick question. Why are those exemptions exempted? Like, for example, if you're a beneficiary and you get, let's say, a house, is that exempt because they're going to get taxed on it themselves after the fact?
Ontario doesn't have an inheritance tax that beneficiaries have to pay. The taxes are paid from the estate. So when the beneficiary receives the gift, it's like a gift that a person gives them during their lifetime. It's free and clear of taxes. So they just receive it. But the state has to have filed their taxes and tax returns and paid all of the taxes owing before they're able to make any distributions to beneficiaries.
For sure. That makes sense. So then, in a backwards way, can you just have a really good will where everything has a beneficiary and then can you avoid taxes that way?
Oh,
Uh-huh.
yeah. Oh, yeah. So
Okay.
it's very, very common among spouses because a lot of property they own is joint. So bank accounts, um, title to their home is joint. If they maybe have an investment property like a condo, that may be joint as well. So all of that bypasses the estate. Those assets do not flow through the estate because they're joint, and the spouse gets right of survivorship. Then there's are certain accounts that cannot be joined, like RSP, TFSA. Those accounts allow for a beneficiary to be designated with the financial institution. So if there's a bit, the spouse is the designated beneficiary, those flow directly to the spouse. And there's also, for accounts like this, there's also like something called a spousal rollover. It's a tax concept. I'm not going to get into that, but it allows the spouse to pay less tax. Basically, reduces the tax payable by the spouse. And what else? Oh, yes, any pension or life insurance, those also have um, the ability for the person who's planning their estate to name designate beneficiaries. So those would also flow to the spouse outside of the estate. And and then there is no there's nothing to flow through the estate that would require probate tax or state administration tax. But there's like other things, like for example a business or an investment account that you're not naming your spouse as joint because they're your savings, but then there's no ability to set a beneficiary. So those accounts would be exposed to state administration tax unless you do a different kind of estate planning. You There's more complicated estate planning that can be done. Yeah.
Mhm. Okay. Raluca, thank you so much for your expertise. As always, always like, comment, and share, and we'll see you next week for even more information. Thank you.